Hi guys, right, so these are quick information bits, if you like, to help. They don't replace the study of the chapter, but they just really highlight some of the big points. So let's jump in straight away. Conceptual framework. I hope to make these as short as possible. Conceptual framework, 8 chapters. Chapter 1 looks at a number of areas. So number 1, of course, it has an introduction. It reminds us of the purpose, if you like, of the framework. Framework are underlying principles in effect. We in effect have just had a revision of that conceptual framework, a revision of those principles. Effective date 1st of Jan 2020. Why? Previous framework, useful but incomplete, needing improvement. Main changes: measurement basis, so a clearer discussion on what the measurement basis should be: historical cost, fair value, or value in use. Presentation and disclosure, a bit of more information there as to what we do with information, whether it should go into statement of profit or loss or other comprehensive income, depending, of course, on the driver of that initial entry. Derecognition, more information on derecognition, when assets are still in control and whether or not we should continue to retain them or we should expel them and therefore derecognize them. We see an update as well as to the definitions of assets and liabilities, which we will come back to. So quickly jumping back here, this question of purpose. We know that already. The whole point here is to assist preparers of financial reports, enable us understand and interpret standards, and assist the board in developing new IFRS standards based on consistent concepts. Let's jump straight away into chapter 2. Chapter 2, we are looking at the qualitative characteristics. This is fundamental. What's fundamental? Once upon a time, we talked about all sorts of things. We would literally break down all the actual principles into materiality, cost concept, going concern, blah, blah, blah. No, now we have 2 fundamental qualitative characteristics: fundamental, relevance, and faithful representation. Underneath those, we have some others, but the fundamental ones: relevance and faithful representation. What does it mean to be relevant? Relevant means, is it material? To include or not to include? Will omission make a difference to the user? Should it be there? Right? And of course, you can understand why, in terms of assets and liabilities, we put assets there and we put liabilities there, because they are material and they do make sense to put them there. They do. Excluding assets that should be on statements of financial position will mislead the user, in fact. Disclosures. Would the user want to know? And when we talk about users, you just think liberally about users here: investors, preparers of accounts, governments, tax required entities, shareholders, you name it, they're all users. We would also like information, of course. We've just quickly discussed the fundamental characteristics to be comparable, verifiable, timely, and understandable. But we must almost think of this in the context of relevant costs. What's the point of having all this, spending all this time, making all of this when it's all very expensive? Very quickly jumping into the other one: faithful representation. Just by the sound of it, is it neutral? Is it free of error? Is it complete, if you like? What is the substance over form? Now, of course, this will always be subjective, and there will be areas of judgment, if you like, and areas of probability, and areas of measurement uncertainty. And this, of course, it connects very strongly to this issue of measurement basis. The question is, you and I might disagree on provisions. You and I might disagree on whether or not a certain asset that's internally generated should be recognized. So the key point here is that we have measurement uncertainty, and we need to think about that. We still need judgment. What is measurement uncertainty? Means, given the market conditions, the level of information in arriving at the figure is slightly is variable. So we almost have to go back again to what measurement base has been used. We talk about levels of information: level 1, level 2, and level 3, as guiding us to arriving at this point. Okay, great. Now let's move very quickly into, I'll jump to chapter 4, where we talk about the updated areas here. We look at the new definitions of assets and liabilities. What is big here? So critical. On the old syllabus, on the old standard, on the old framework, we defined assets as a resource controlled, a past event, and future economic benefit expected to flow. What is new? Purely, we're looking literally at the asset. We just want to know, present economic resource past event. That's it. They have taken out this idea of future economic benefit from the definition, and we'll come to this question of recognition after. But from the definition, we're purely looking at the fact that it's present. Economic could mean it might be sustainable, it might be to do with other, it could be to do with not your classic non-financial. Key point here is that you have something on there that can be recognized. And we're purely looking at that definition. Here we are. So then let's look at the liability. Kind of same with the liability. Liability, old definition, present obligation, past event, settlement, expected to result in an outflow. New definition, present obligation, transfer of economic resource, but nothing to do with economic outflow. Purely in the definition. Purely in the definition. So kind of going back again to just relevance. Should it be there? What is the thing? If you like. There is an additional thing with the liabilities. There is a duty and there is no practical way you can avoid. So typically if there is a if it is normal that you would deal with it, or that you would pay for something, or that you would clean up in terms of cleanup costs, and go ahead and recognize that, if you like. It's almost inferred. Right, so when we come to recognition here, you can see I highlight here that the focus is purely on the resource. With recognition, when we now ask, can we recognize it on a set of financial statements, we need to consider the flow, the probability of flow, kind of, if you like, coming back to this question of, will there be an outflow? What is the probability of outflow? If you like. So this kind of falls into this, also needs to look at the degree of uncertainty and probability, and this falls into the area of faithful representation. So in a way, they've kind of split up these definitions into relevance and into faithful representation. Cool. Moving quickly on to the final bit of this here. I highlight the question of recognition. So the question of recognition, to include or not to include, to recognize or not to recognize. So first of all, first step, are you an asset, liability, income, expense? Yes, you are. Great. We can even discuss that. So this is the area of relevance. No, you're not. We're not interested. So question 2, now that we know you're one of these in terms of you're relevant, can we recognize you? So again, like I highlighted, test 1, what is the probability of economic benefit of flow? Relevance. Does the asset really exist? Can we measure reliably the flow? Faithful representation. And then finally, where will it go? Statement of profit or loss or other comprehensive income? Faithful representation. So you can see how all of this kind of ties in together. I think I talked about here. I think I talked about here. We talked about. I'm already on 7 minutes. I need to end very soon. So chapter 6 then talks about measurement. Yes, that's right. Big chapter, new chapter, connection to faithful representation. So they give us some very good, clear guidance. We now can measure it. Fair value, current costs, or value in use. Fair value, exit price, current costs, entry price recalculated. So whatever, find out what the price would have been today, but take it back and then depreciate, if you like, going forward to its current date, right? So that's the current price. So entry price recalculated. Fair value, what we could sell it for today. So it's really asking, you can see that this measurement basis, this measurement very much connects to faithful representation, helps whether or not we can even end up, if you like, recognizing what's going on. Remember, this is very much a backdrop to after you've studied the syllabus and you're just kind of sitting back and just reflecting on the material. And yes, and that's pretty much it. I mean, these were some of the things that the plan was. It was to look at these new the framework, the objectives in chapter 1 looks at the qualitative characteristics, looks at those definitions of what these things are. Criteria recognition, which we've talked about, measurement basis, and guidance on disclosure. Of course, it must be about relevance. So we know that the statement of profit or loss is about short-term income or short-term expenses, but if we're talking about assets that will continue to the future and we're not realizing them straight away, it should be going into other comprehensive income. I think that's enough here.